Hello, hello, everyone. Welcome back to another episode of Signal or Noise. This is episode 31. Charlie Bilello here, and with me, as always, Peter Mallouk. Peter, this is I think the first Signal or Noise that we're recording during a little bit of market turmoil, and some would call it a crash if we look at things like the Nikkei. So we'll run through that. So exciting episode. Definitely stick around to the end. This is what we're going to be discussing today. Number one, embracing panic. So there's really two things you could be doing on a day like today, recording this on Monday again. You could be panicking and selling everything and listening to the pundits who are telling you to do that, or you could be embracing it as a long-term investor. So we'll dig through that. Two, the rate cuts seem to be finally coming, and you and I could talk about whether the Fed should be cutting, how much should they be cut, and maybe even should they be doing an emergency cut, which some people are calling for. Number three, a costly rollover mistake. This is a big one. Anyone who's at a 401k roll their money over into IRA. There's a lot of interesting data points on what people are doing with that money or not doing with that money. Number four, love and marriage. No, we're not going to be talking about that part of it. We're talking about the bank accounts of couples. Should you have a joint bank account, separate bank accounts? Big debate going on there. I'll give you my opinion, Peter. I want your take as well. And we'll end, as we always do, with signal or noise. Bonds are acting like a hedge again. It's about time. If you're a bond holder, you've probably been saying this for a while. We're finally seeing bonds prove their worth during a correction. All right, number one, embracing panic. This is kind of what set it off, Peter. And the interesting thing was bad news was bad news again. So we got that weaker than expected unemployment report, 4.3%. Market was expecting, I think, 4.1%. And that really set off a big sell-off on Friday. Recession fears were elevated. Why are people worried about a recession? Well, I've shown this chart on Signal or Noise before, but I've updated it now with that 0.9% increase off of the low last year. We're talking now about a historical precedent that's undefeated in terms of predicting a recession. There's never been a 0.9% increase without the economy being in a recession already or about to begin. That was in 2020. But other than 2020, the economy was already in a recession at this point in time. Before we dig into the market's reaction, any thoughts here on the rise in the unemployment rate? Are investors overreacting? Are people calling for a recession here? Very quickly, big shift, right? All of a sudden, we got that good GDP report for Q2. Everyone's saying, okay, the expansion is going to continue. And then immediately it shifts after this unemployment rate. Is this an overreaction?
Well, I don't think we can attribute the whole reaction to this. So it's hard to say it's an overreaction to this. I mean, this is probably a piece of it. What's happening with the Japan trade is a big piece of this. I think sentiment's a piece of it. Potential World War III is a small piece of it, I think. But if it was just this, then yes, I think it's an overreaction, because I think a part of it's not just that there's an increase in the unemployment rate. It's what is the unemployment rate to begin with, right? If things are already soft and they're going in the wrong direction, that's pretty tough. But we have had a labor market that's been way too tight for way too long. So as everyone agrees, I mean, whether you're economists or involved in markets or whatever, it's been a very tight market. And so the Fed wants to see a little bit of a softening. Economists want to see a little bit of a softening. So this is actually generally an okay move here, and I don't think by itself is the reason that what we see with the markets is happening. I'm curious your take on this.
Yeah, to your point, let's first just say 4.3% is still pretty low for the unemployment rate. The historical average is 5.7%. So part of it for sure is coming off that ultra low reading we had in April 2023, when we had really the tightest labor market we've seen in history. There was such an imbalance after COVID in terms of the huge number of job openings that were unfilled. And month by month, we've been getting closer to a normal labor market. I think we're actually finally there in terms of a balance between supply and demand. So certainly that's a good thing. I guess the question of saying, is it a signal of a recession? I would say, just looking at this chart, it would be hard to say that this time is different but there's always a chance. Like we've seen crazy things before, and is it 100% that we're going to be in a recession like here and now? I don't think it's 100%, especially as we'll talk about next week on the next Signal and Noise, especially with the amount of fiscal stimulus that we're still doing here, running these enormous deficits.
I think that's the issue. Is you still have low unemployment, you still have money, too much money sloshing around. It's very hard to see with this much capital and this many people working how you really need the trend to continue substantively and quickly. Which is obviously it's possible, which is why it is possible we're going to recession. I just would not consider it to be the 100% like we see here with all of history. It just tends to be a perfect guide.
Yep. We'll look back and just keep in mind also with recessions, they come in all different shapes and sizes. And sometimes they're long, sometimes they're short, sometimes they're deep, sometimes they're shallow, sometimes there's a huge number of layoffs and unemployment rate rises to 10%. Other times it doesn't. So it's not, even if it is a recession, it's certainly not clear how deep that will be, how long it will last, and how the stock market will react to it. We know is different every single time. But speaking of the stock market here, Peter, as we record this, we're seeing the biggest pullback off of an all-time high since 2022, 9.7% for the S&P 500. And this is really the only time I look to see why people are saying the stock market is selling off, because it's really of no value, right? To say in the past, it's already occurred. Well, why is the stock market selling off? No value whatsoever. But to create this table to fill it in, I put in these reasons, and I think it's helpful to go back in history and look at some of the reasons that seemed very important at the time, and then all of a sudden the market says not so important anymore. So why are they saying the market is down almost 10% from that July peak? Disappointing earnings results. That was the start of it. That's what people are saying at the start, where simply the expectations were incredibly high heading into earnings season. And it's not that earnings were terrible. They haven't been terrible. They just haven't been as good as people were expecting them to be. And then number two would be the recession fears that we're talking about with that unemployment rate, other economic data people are worried about. And number three, as we'll talk about in the next section, would be this idea that the Fed is behind the curve, that the Fed should have already cut interest rates when they met last week, and that's causing problems for the market. So we can debate whether these reasons are true or not, but this is what people are saying. And just in terms of the US, obviously, market decline, nothing as compared to what's happening in Japan. The Nikkei 225, last two trading days, 17.5%. So this is now worse, Peter, the last two trading days than October 1987 or October 2008 or March 2011, these other big sharp declines. And if you go on X and you look at all of the engagement around this crash, it's all fear inducing. It's all get out of this Japanese stocks, get out of the market. Markets are crashing. Don't you see you should sell everything? Nobody looks to see, well, what happened to the Nikkei a year after these previous big crashes? And lo and behold, I just took a quick peek this morning. Well, this is actually what happened after 1987 crash. 25% gain over the next year after the October 2008 crash, 43% gain after the March 2011 crash, 18% gain. And my message to people on X, if you're listening, crashes equal an opportunity for long-term investors. Your thoughts here?
I think, of course, we see the same thing with U.S. markets, international outside of Japan, that when you see these big pullbacks, people think that the way it works is that this will continue, the downtrend will continue. So we have this recency bias. And then they also think when it's over, that you get normal historical returns, whether it's 6 to 11%, right? And that therefore it will take 4 or 5 years to recover. And that's not how it works. It's like a rubber band. The further you pull it back, the quicker it springs forward most of the time. And so it's like you're taking a road every day and the road is blocked. Whenever that cloud is that's over things, whenever that roadblock is about to be removed, the traffic doesn't take 5 years to get back to where it was. It instantly returns back to what it was before because the roadblock has been removed. Same thing with markets. When we see an overhang in the markets, like let's take example COVID. Once we see, oh, everyone's not going to die, there's a solution, right? all of a sudden the market recovers everything in a matter of weeks and months, not 5 years. Same thing we see here with what you're showing with Japan and what happens with all markets. The second the cloud lifts, the key is we don't know when the cloud is going to lift. That's where the panic and the fear and people that aren't educated really make mistakes that they can't recover from. But for the long-term investor, as you point out in your tweet, opportunity, opportunity, opportunity.
So it's all about time frame, I
Yeah.
think is the important message, because when I post things like this, the immediate question people say, well, what happened the next day, the next week? Well, you shouldn't care about that. First of all, it's going to be mostly noise, irrespective of that, but you're not going to be able to time that. Certainly, you can go down more. The point of this is to say, 3 weeks ago, Peter, there was a lot of bullishness surrounding Japanese equities, a ton of it. The Nikkei was up 27% on the year. Everyone seemed to be in love with this index, and now it's actually down on the year, and investors hate these stocks now. That to me doesn't make any sense. All the best you can say is it's clearly a better time for a long-term investor to buy these equities today at these valuations as opposed to a few weeks ago. Anything more is just speculation. Obviously could continue, but definitely better than it was a few weeks ago. Now we have to talk about volatility here, and this was just an outright panic that I saw this morning in terms of the VIX. We really haven't seen this historically other than October 2008 and March 2020. We had the VIX this morning at 65. I had to keep refreshing and say, is this a correct number? I checked like 5 different sources. It was actually a correct number. I mean, the S&P futures were only down 4% and change, so I didn't expect this type of move in the VIX, but clearly people were positioned incorrectly, and just the expectation, I don't expect this to stay at this level for very long. It's probably much lower as we speak, but 65 for the VIX would be the third highest period in history if it were to hold. And what we see in terms of the VIX, as you and I have discussed on prior episodes, is it's a huge signal when you get these types of spikes, or at least it has been in the past. If we look at the highest weekly closes for the VIX that I've listed you here, every single time you see the market substantially higher over the next year, and usually outperforming the average from other periods of time. And if we just look at the VIX in general versus high levels of VIX versus all other VIX levels, it seems to be an opportunity more often than not. So
Now, I
should
will
it,
say, yeah, I
yeah,
will say though that the VIX, like if you look historically, normally it accompanies massive drops. What's so strange about this one? It's a
yeah,
couple percent drop. It's happened, dozens and dozens of times throughout history. That's the anomaly here that I think is interesting to see such a high reading here relative to what's actually happening in the stock market. We look at the past readings correlate to
yeah.
very severe drops, which is why you
50% decline in October 2008 and 30% plus decline in March 2020. 100% and only 10% here, and we're at 65. Yeah.
right.
So very strange. So I don't know what to make of that, other than it's probably a reflection of just the extreme bullish sentiment that we saw a few weeks ago and the rapid shift from there, and people just being positioned incorrectly or not prepared for this type of decline.
Well, a lot of people very risk on. I mean, we've gone a long, long time with the market having very, very low volatility, very few down days, many, many record highs. Very easy to increase your options, increase your margin, place options trades that are maybe a little more aggressive than normal. So those people are probably pushing the limits. I'm sure that's a part of this too.
100%. So what would save the market here, Peter, more than anything else? And I don't know if CNBC watches Signal or Noise, but if you're watching CNBC, please do a markets in
Please do
turmoil
it. Please.
special today. And I might even agree to come on if you ask me to do it for a markets in turmoil. If you let me show this chart, that would be the only
Can you
request I would have.
imagine that? Yeah, that would be.
So we'll see, Peter, but it would be good to see, and certainly would be much worse things that you could see today other than a markets in turmoil. But maybe it just hasn't been enough yet, or maybe they've seen this chart and then they're just simply getting too much bad press from it. They're not going to do it anymore. I don't know, but certainly that would be a good sign for investors. Okay, number 2, we got to talk about Fed rate cut expectations. Here come the Fed rate cuts, and what we've been saying is you really have to wait until you're getting close to the meeting and the market's pricing it in to have a high degree of confidence that the Fed is actually going to do it, because the Fed really looks at market expectations. And what we've seen, Peter, in the last week is a stunning shift in terms of those expectations, where markets were saying before that employment report, we're going to get a 25 basis point cut. And now the market is actually saying 50 basis points is guaranteed for September, and maybe we even get 75. And this morning, we have Jeremy Siegel, not prone to making these kinds of statements normally, saying the Fed needs to do an emergency 75 basis point cut today and then do another 75 basis points in September. What do
You
you
know,
make of this? Do you think that's called for at this point after a 10% decline?
Jeremy Siegel is a genius. One of the greatest books I ever read, maybe 20 years ago, but probably longer, maybe 30 years ago, was Stocks for the Long Run. He
100%.
has spoken at several of our client events. He's speaking at our client event here next month. The guy's a legend. I've been on his podcast a few times, and I'd much rather interview him than him interviewing me. But this seems a little much. I mean, 75 basis points, it seems like a big overreaction. Now, you and I know Jeremy's a very big stock market guy, and he's all in on whatever on stocks for the long run, right? That would certainly help stocks. I think that part of how we got into this mess is the Fed making very extreme moves over the short run. And so I've liked watching the Fed move slowly and deliberately for a change. Now, a lot can change between now and the next Fed meeting that might make the Fed make this make sense. But today, with today's set of facts, it seems extreme. I think what the market is expecting, which is almost a 90% chance of a 50 basis point rate cut, followed by more rate cuts after that, seems a lot wiser. But look, I mean, we're bickering about 25 basis points, and the man is brilliant. So who knows?
Yeah, I think if the S&P were to rally back and we see a recovery very quick, all of a sudden those odds will change very quickly, and maybe even 25 basis points is back on the table. I'm not saying that the Fed doesn't look at what the market is doing. They clearly do, and they've certainly reacted this way in the past, for better or for worse. In my opinion, for worse. They shouldn't be. Their mandate isn't the S&P 500. It's talking about inflation and employment. And if they're going to do it intra-meeting, they can't wait until September. Well, that would signal, I think, to markets that something's very, very wrong,
Yes.
and that they just didn't see even a week ago.
Yeah, 100. Yeah, that would be terrible if they went if they went before the scheduled time. Now, what they could do is send clues, right? But I think that the best thing is just the markets think there's 50 basis point cut. Let's wait for the meeting. That's probably what will happen. That's probably the best case scenario without instilling panic. I think the unemployment spike is probably what's driving Jeremy here. But again, we got to look at from the levels it's coming from and put that into context.
Yeah, and we'll get another employment report before that September meeting, right? So what if we get that employment report and it comes back down to 4.1%? Everyone will be changing their tune, I would think. A lot of people talking about weather-related issues in that employment report. So who knows how big of an impact that had on that unemployment rate. So we'll get another CPI print. We're going to get another employment print. So more data for the Fed to parse. But I just think these types of emergency measures, without a real emergency, would send a message to investors to say, you should actually panic here because we know something that you don't know. Now, I want to kind of dispel the myth that this rate cut is going to be this big panacea, that it's always a great thing for the markets that you have the Fed cutting rates. And it's really just a lack of studying history if you're saying that sometimes a rate cut can be good for the markets, but certainly not always. And if the Fed is cutting interest rates because they see an oncoming recession, that could be actually not very good news for the markets, because the markets are thinking then, okay, there's going to be decline in earnings. They're going to be looking at valuations and saying, oh, valuations are high. So if we look at historically here, Peter, when the Fed cut rates in 2019, in 1998 and 1995. They did 25 basis point cuts. The market did okay the next year, the next 2 years, certainly did fine. When the Fed cut 50 basis points in September '07 and January 2001, before the recessions that started a few months later, you could see what happened with the stock market over the next 1 year down, 2 year down, 3 year down. Now, this time is going to be different, right? These, of course, were both before long bear markets. That's going to skew the data. But I think the overall point here is be careful what you wish for in terms of saying you really want the Fed to cut rates aggressively here and go back to 0%. I think that would be a signal that something's very, very wrong for the economy. And that might not be necessarily very good news for the stock market.
Yeah, I think it's a good time to remind our viewers and listeners that the stock market only cares about one thing. We talked about so many things today, right? So far, and we're barely into this thing. Japanese markets, interest rates, what's going on with the VIX today while we're recording this. The stock market only cares about one thing, and that's expected future earnings. So when we look at these moves with basis points with rates, when the Fed's cutting 50, 75, it's because there's a massive risk to the economy, which in turn impacts employment and companies making money, which companies making money is what drives stock prices. So if, to your point, if the Fed come out and said, we're lowering things 100 basis points, you might go, oh, well, that's amazing. Well, that would really signal, like you said, that they see a massive structural problem with banks and the federal debt and all of those things. And a massive problem, that's like 0809 or COVID or post 9/11. Those are the kinds of things that really are structural or really can have a very long impact on the ability of companies to make money. When you see smaller moves, you're seeing them go, oh, we went a little overdid it. It's Goldilocks, right? It's a little too hot, it's a little too cold, getting back on track. Those are much more deliberate, and I think they signal to the market a much more positive tone. And so this is why I don't love the idea of a 75 basis point cut ahead of the Federal Reserve meeting. I mean, just the panic it would set in for a rational observer would be very negative.
No good reason. And that would just clearly send a signal also that the Fed has no idea what they're doing in terms of setting rates if they could get that wrong in a week's time.
Yeah.
And you know my view on this. The Fed should not be setting interest rates to begin with. I don't know where the Fed funds rate should be. Jeremy Siegel saying he does. It should be 3.5 to 4%. And I'm sure he's saying that because inflation's around 3% and he thinks it's going lower. I don't disagree. That might be the appropriate level. I just don't know. The market should be dictating it, not the Fed. So maybe 5% today is too high, or maybe it's too low. We only know that in hindsight, but I'm not going to win this argument. The Fed is going to continue to set interest rates because people want to believe that there's this all-knowing body out there that can prevent recessions through interest rate policy, that can help markets through interest rate policy, that they know better than the rest of us, even though clearly that's not the case. That's, I believe, why the game goes on. Am I wrong about that?
I think you're completely right. I agree completely.
Okay, so last point on the Fed funds rate, regardless of what the Fed funds rate, is in the next year, the next few years, I want to make this point once again clearly to investors. If you just look at the data and you break down the Fed funds rate into different quintiles and you say, what has the market done over the next year, 3 years, 5 years, 10 years, and you look at it even on a real basis, so you're taking out inflation and you're saying, oh, is the Fed easy? Is the Fed tight? What you can see in this chart, Peter, clearly is it almost doesn't matter. Yeah, there's differences in terms of the return, but they're all positive on average. And the most important point is it increases as you go from left to right. So if you're an investor for the next 10 years, you shouldn't care where that funds rate is. You should just know that you're likely to have a better return if you stick with the markets for 10 years versus 1 year, and so on and so forth. So keep that in mind in terms of all the noise around the Fed. Everyone likes to say that Fed policy is everything when it comes to the stock market. The data historically does not back that up. Okay, I want to go to number 3 here, moving away from the markets with something very, very important, probably more important for most people because most of people's wealth in terms of the stock market is held in 401ks or IRAs. And this is a huge, costly rollover mistake that many people are making. So, interesting study here out of Vanguard. What they did is look at the people who are rolling over their 401ks into IRAs, and they're saying, well, what percentage of these investors didn't invest that money when they did the rollover? They did the rollover, and there's no automatic thing where it goes into a target date fund or it goes into a broad equity fund. It'll just sit in cash until you allocate it. And look at this data here, Peter. 28% of these IRA investors left it entirely in cash 7 years plus. And the fascinating thing here to me is looking by age, the investors who should have been investing it immediately, the younger age group, 20 to 29, well, more than 50% of them kept it in cash for 7 years or more. And actually, older investors were more likely to put it to work. What do you make of this in terms of just what it says about human behavior and inertia?
I mean, inertia is so powerful. You just roll it over, you forget about it. And I mean, this is something that costs the typical person doing this probably delays their retirement by years. This isn't like it adds a couple weeks or a couple months. I mean, even if you have $60,000 that you've rolled over and it's sitting in cash, and like this chart shows, the group that's age 20 to 29, that's devastating to forget about it and not get it invested. It's the reason that 401k plans now have QDIAs, right? Where when you participate in a 401k plan, if you do nothing, you will default into a portfolio that at least has some stock market exposure. And everyone's been better off because of that. I don't think that should ever step into the world of IRAs. But I do think that, look, if you're listening, go back and you've rolled over your 401k and you've not taken a look at it since you did it. I think a lot of people just assume I was invested in the 401k. I fill out this paperwork and it moves over here and it's also invested in some stuff. Not how it works at all. You have to take one extra step and get it invested.
Yeah, and I agree with you there because Vanguard in this piece is arguing, and maybe they're talking their book. They probably are. They're the biggest manager of these target date funds, but they are saying that it should automatically go into a target date fund. And if it did so, they're estimating here the average person who did this would have 130,000 more at age 65. There would be 172 billion net benefit to all rollover. I don't disagree with anything. I just think the IRA it's your personal choice, and for whatever reason you might want to keep it in cash. Some people can use IRAs if you have a Roth IRA towards the purchase of your first home, so that might be a thing. It's just a lot of different reasons that people might have, but most of it, I suspect, is inertia. They probably would benefit from that nudge. I think a better way would simply to say a reminder every month, every quarter, if you have that brokerage account balances. And I know there's a lot of conflicts here because brokerages are making money off of these investors keeping their
That's
money in
exactly
cash.
right. Yes.
But it would be very easy
That's a
for them
lot of
to,
this. Yeah.
just
Yeah.
to send them an email reminder every month saying, look, you have 100% in cash, you know, evaluate that.
Yeah.
Do you want to do that? This is what it might grow to if you put it in the stock market historically over the next 30 years. Something as simple as that. And then people can make up their own minds. But what was fascinating to me, Peter, is it's not just rollovers. If we looked at the people contributing to an IRA, so they're funding that IRA, 5,000, 6,000, whatever, they're putting it in there. Those people as well, even actually a higher percentage of those people are actually staying in cash for 12 months. And it's probably the inertia things, but it's also what we come often back to is they're probably saying, well, now might not be a good time. Like if they, let's say they contributed on day like today, they'd be like, maybe I should just wait until the news gets better. We might be going to a recession, right? So I think it's all of those reasons as well. But once again, it's just a crazy thing that the younger investors in these groups, they have a much higher percentage of allocated to cash than older investors, and I just can't explain that whatsoever.
Less likely to have an advisor, have a smaller pool of monies, less likely to pay attention to it, less educated on the power of stocks over the long run. I think there's probably a lot of reasons
Yep.
that we can speculate
Yeah.
around here.
Yeah. Certainly. Okay. And on that point, with the advisors at Creative Planning, we're here to help with that. So reach out today creativeplanning.com/Charlie. Get your free wealth path analysis. We'll be going through all of your accounts, doing a portfolio checkup, making sure if you have an IRA sitting around that's not invested, we'll tell you the different options of how you could invest it and what that would grow to over time. We'll give you a free retirement roadmap. Make sure you're on the right path. We'll look at your tax situation, estate planning documents, make sure everything's in order. So reach out today, creativeplanning.com/Charlie. We're in all 50 states, so we likely have a location near you, and we have over $300 billion in assets under management and advisement. We're here to help. Okay, number 4, love and marriage, Peter, a topic we haven't talked about yet, and perhaps it's time for us to discuss this. But in the financial realm here, joint versus separate bank accounts, a lot of heated debate going on about this, and not everyone certainly is in agreement. There was an article in the journal I found really fascinating about the high percentage of couples who actually are itemizing their monthly bills and dividing household expenses based on their incomes. So as it turns out, 62% of married adults and those living with a partner kept some or all of their finances separate. And what they're saying is that the best way to divide the mortgage, the car payment, Netflix, is to do it based on who's using the money for those things or based on the person's income. And they gave an example here of a couple where they're putting all of their bills into Excel. And in June, Anna pays 56% of the expenses, and her husband, Ross, is paying 44% based on a ratio of their salary. And then they each keep whatever money is left. Before I give you my take on this, when you speak to clients about this type of stuff, what is your generic advice? Obviously, there are some situations where maybe it doesn't make sense to join finances, but to me, this seems a little bit crazy.
I'd start by I'd start by saying everybody's different and everyone should do whatever works for them, right? I don't know where this research was done. I will sit with multiple couples and individuals a day, on average, every day this entire year. I'll probably be in at least, I'd say 500 to 800 meetings. This is not what I see, right? What I see most of the time, the overwhelming majority of the time, is I see a joint account that covers the mortgage, the household bills, and everything else. Now, to be fair, I'm sitting with people that are millionaires, multimillionaires, and up, right? Maybe that's different than maybe it's segmented by income. I just don't see this. So
Okay.
I'm fascinated by this. And whether I agree with it or not is kind of irrelevant. Like, if you've got a couple and the couple is going to feel better this way and have a better relationship this way, then this is what they should do.
What if they asked you? What if they're debating it? One says they want to make everything jointly, and the other one says they want to keep it separate, and they're coming to you to break that tie. What do you tell them?
I would tell them, you're in this together. You're a team. Even partners in a business have a joint account. They have separate business accounts.
Yeah.
And I would like to think that a married couple is a stronger union, right, than business partners. So I would suggest that they start by having a joint account to cover a lot of these expenses and see if that works for them. But at the end of the day, whatever works for them, right? So
Sure.
I will say I see some couples have a joint account and they each have an individual account for day-to-day. Again, whatever works. But what I'm seeing hundreds of times a year is usually the married couple having a joint account that they operate at least all the household items out of.
Yeah. And
you obviously have an opinion that you don't like this angle, I assume.
Not unless there's some kind of crazy reason where you should be keeping it separate. I mean, it's just, if we look at just the breakdown in terms of who makes them, there's often a huge disparity. And to say, like, because the husband is the primary breadwinner or the wife's the primary breadwinner, that they should be, keeping more of the money or in their own account, or they should be having to spend more on expenses, like, that doesn't make sense. So just blending everything once you're married, especially the assets you're accumulating while you're married, right, which legally are going to be shared equally anyway. So the only exception I would say is if you had, let's say, a huge disparity, or there's a second marriage later in life where you have more complicated situations, then I would say don't merge it. But if you're in an equal position and you're earning this money together, viewing it as a family unit and making those decisions together, and instead of saying, well, you have this full reign to spend what you want in this account and I have it in this account, and then it's going to lead to huge arguments later. So it's just putting off the inevitable. Like, there's no way that just to have those siloed, that it isn't going to come up, I think, overall. And I think the research, if you look at it, supports my view. And so all of those couples that you're speaking to that are saying they're already doing it jointly, well, they're probably happier because of it. And what they found, they're looking at 5 different studies, is that couples who pull all of their money have greater relationship satisfaction than couples who keep all or some of their money separate. And the reason for that is they have increasing of feelings of togetherness. They're making purchases and financial goals feel shared, and that mediates the relationship between joint accounts and well-being. So there's a connection here. I guess you could make the argument that perhaps we're confusing cause and effect, and couples that are already happy are likely to have these accounts together, and couples who are arguing and fighting are probably more likely to have it the other way. So what is it causing your marriage to be happier? Maybe not, but I think just overall, to me, intuitively, it's a simpler system. It's better transparency. It's a more open system. It's a fairer system, I think, to have it together. So for all
Well, and
those reasons,
you're in
I
it
think it's better.
together. You're in it together.
Yeah, for better or for worse. And if there's a dispute about where to spend money, you might as well have it together as opposed to allocating to different funds. Okay, that's our take. But as you said, if someone feels strongly otherwise and it's working for them, go ahead, by all means, keep doing it. Okay, we're going to end, as we always do, with signal or noise. And this is we're revisiting one that we did, I think 2 months ago, looking at the correlation between U.S. stocks and U.S. bonds. Peter, here you can see very clearly on this chart, the correlation over the past 3 years was at a record high as of the end of June, 0.71%, which essentially means that stocks and bonds have moving together more closely than they have been at any point in history. And that particularly was annoying to investors in 2022 when stocks were going down and bonds, which normally cushion that blow, didn't do that year, because the reason why stocks were going down is because of a fear of higher interest rates and higher inflation. And so what we said a few months ago on the signal or noise is, when is this going to break? It's going to break when the investor attitudes change to the point when their biggest fear is no longer inflation, but it's the economy and it's a recession. And when that happens, bonds are then going to start behaving very differently, because you're going to have, on a stock market decline, interest rates falling. And that's what we're seeing today. You have the 10-year below 370 this morning. Just a huge move, one of the biggest short-term moves we've seen in history to the downside. That's pushing bond prices up. And we can see, since the S&P peaked in July 16th, bonds are up a few percent, S&P down, NASDAQ 100 down double digits. Now, bonds finally proving their worth to its portfolio after a pretty long and tough drought. Okay, is this a signal to you that perhaps this is a change in terms of the behavior going forward, or just noise, or we don't know, and we'll take it? If you have that 40 in bonds, it's finally doing something for you. You should be happy about that.
Yeah, I think that the like you said, that the bear markets usually happen for a reason, like a mortgage crisis or a terrorist event or something like that, and bonds go up and stocks go down. But when the stocks are going down because rates are spiking high because of high inflation, the Fed's raising rates really fast, which obviously negative impacts bonds. This is just what happens a minority of the time. And so when you see bonds and stocks go down together, that's the exception, not the rule. Or back to more of the norm.
Yeah, I think it's a sea change here, assuming inflation stays tame and stays on the course, and we don't have another record spike in inflation up to 9%. The behavior is going to go back to more normal, and that's not to say that it's going to be negative correlation. It's usually around 0 on average between stocks and bonds. Just say the drivers are different between stocks and bonds. Bonds are 100% about interest rates, and stocks are about a multitude of things, earnings, expectations, of course, being the most important. Here's an interesting stat that I want to end here on here. We talked last episode, Peter, about is now a good time to rebalance. Pretty good timing on that, I would say there. The S&P 500 had been up 100% over the previous 5 years, 15% annualized, and bonds were flat. Of course, nobody wanted to go into bonds, but bonds provided a better opportunity they had in years because interest rates were obviously higher. And all of a sudden here, we have this situation where if we look at the past year, bond returns not that bad, 7.7% for the aggregate bond ETF. That's actually above the interest that you would have received on a cash position like Treasury bills, 5.4%. So very interesting that once again, this is what we saw last year as well. Returns are not linear in the bond market as well. So we went from a pretty bad year about a month ago in the bond market to a decent year now, and certainly good over the past year. Any thoughts on that with the Fed now likely to cut interest rates? And a lot of investors have been hiding in cash and thinking that cash will always have that 5%. We've been saying it's not going to stay there forever. And now it's probably only going to be another few weeks of where investors can get that
Yeah, we've been
5%
saying it
risk free.
forever. It's finally here. We're back to the low rate. We're going to be heading back to the lower rate world we lived in for decades before, I believe.
Yeah, hopefully not zero, but probably not going to be 5% in the near future. And it just goes to show you having that diversification, especially when it's most painful after that interest rate rise. Now it's proving its worth. And if we look at historically during rate cutting cycles, bonds have done pretty well above average returns. Now are bonds front running that move today? Seems to be that way clearly. But I think investors should keep that in mind as well. Perhaps interest rates could even go even lower in the next year, and that would certainly help bond prices even more. Okay, Peter, covered a lot of ground there, a lot of different topics. That was a fun one. Thanks everyone for joining us on Signal or Noise. If you're watching this on YouTube, hit that subscribe button, hit that like button, leave a comment. I try to respond to as many comments as I can, and we'll see you next time on Signal or Noise.